Hi, I'm Steve Van Metre, and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of the market, which doesn't make any sense right now. And I'll give you some really good evidence of that. Today, Boeing announced their earnings. They came in below expectations. But more importantly, they said that they are going to indefinitely suspend their corporate share buyback program. Now, Boeing has purchased a substantial amount of their shares back with their free cash flow and their ability to borrow money. Because Boeing has bought so much of their stock back, it has elevated the price beyond where it probably should be. So you would think that the news that they're no longer going to be buying their stock back would be bearish, and you'd be wrong. In fact, the market rewarded Boeing for missing earnings and stopping their share buyback by causing their stock price to close higher today. And that, my friends, makes absolutely no sense. Of course, it also doesn't make much sense that I could not have my PowerPoint loaded up ahead of time so we can read the disclosures as needed. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recognition or solicitation by or security, financial product instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, a personal capacity opinions expressed in the video that alone do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. So something that we should have looked at last week, but due to the markets being closed on Friday and me not knowing for sure the government would put their data out, let's take a look at commercial industrial lending and how it relates to the dollar, how it relates to gold and agricultural commodities and bond prices. Pretty interesting. All the stuff that, well, I'm highly interested in, we can look at here. So let's take this commercial industrial loan chart on the year over year or annualized growth, and let's add the trade weighted. Oops. There we go. And I want against major currencies, not seasonally adjusted, so we'll add it. And by default, what the Fred database, or the St. Louis Federal Reserve Economic Database, does is it puts it in the same format. So these are both on an annualized rate of change. And you can see these are fairly nicely correlated. When the growth rate of commercial industrial loans rises, well, the dollar tends to rise. It occasionally falls in advance, even though it was flat here, and then it rises again. It's almost as if demand for dollars happens when large corporations borrow money. Well, that would make a lot of sense. And sure enough, we see it here. Now, there are periods where the rate of change on the dollar collapses and commercial industrial lending don't. And then there are times that they do. So what we're seeing now is the year-over-year growth rate as the dollar has gone up. Now, many people say the dollar is headed higher, and it absolutely can do that. We could see a move right here, or like this, or up here where it just shoots out of trend. We can see that. But where is the next direction of the dollar headed? It's headed lower. In pretty much every instance, the year-over-year rate of change on the dollar falls as commercial industrial lending does. Now let's make some adjustments to this chart, and we'll stick the dollar onto the right side of the chart over here. But we're going to just make it just the straight index. Let's see what we can glean from this. And sure enough, this is the early years where we came off the gold standard. So let's kind of look more at the later years. So we see a downward trend in commercial industrial lending, downward trend in the dollar, rise in commercial industrial lending, little rise in the dollar here, drop off in lending, drop off in the dollar. This is now here, lending growth is fairly flat, but pretty strong at, some around 10%, 12% a year. So that created some dollars, but as soon as that gave up, dollar went down. Commercial industrial lending rose, was not strong enough to bring the dollar up, but it was in the late stages here. And then lending fell, dollar fell, lending rose, dollar rose. So we could see in the year over year rate of change, this is a lot better. However, what it does say is that when commercial and industrial lending roll over from a pretty weak area, which we just got just above 10% growth, and we quickly gave that back, that weak growth is going to translate into a weaker dollar. And of course, a weaker dollar means higher gold prices, higher agricultural commodity prices, and at some point it does lead to better corporate profits and earnings, but not right away. Not right away at all. So I wanted you to see that chart here because I think it's really cool, and we definitely see that relationship between commercial industrial lending and the dollar. It's a lot more evident here when we put them under the annualized rate of growth. And there they are. So it tells us again, the dollar may have its final move higher, but the overall trend of the dollar should start to roll over, head lower. Again, that fits our narrative of the next big bull market in gold. So let's just, while we're on the topic of charts, we've got a lot of time today because I don't have any other real charts to show you. So we'll just see how far we go. Maybe we'll make it 15 minutes, maybe not. So the S&P 500 made a new all-time closing high yesterday. Did not make a new all-time price high. And people are as bullish as ever that this market is back and going to new highs. The money supply is saying the complete opposite. This is a pretty stunning move that will be reversed. We can look at volatility. It's been scrunched down, and volatility is no longer falling. It's consolidating, looking like it's going to head higher. And if volatility gets out of control, well, then that means the S&P 500 is going to give up its strength. Now, we know there are a number of ways to look at this to prove that the S&P 500 is too high. And one of those is we can look at 10-year Treasury yields, which had this big gap down after being rejected at its 50-day moving average. Remember, we crossed the 50-day, reconfirm. This is telling us we are in a bear market for Treasury yields. They are headed lower. I mean, this is not a chart pattern you get when you think about higher Treasury yields. This does not make any sense. But what we can do is we can add the S&P 500, and you can see that there is a big disconnect between the two. And again, the S&P 500 should be somewhere around 2,600 or lower, not where it is currently today. So 10-year Treasury yields is telling us that's off. The other thing we can look at is commodities such as lumber. We looked at that, I think, last week, and we can see lumber prices have gone sideways, and the S&P 500 has gone higher. So that tells us a second look that the S&P 500 is wrong. And we can look at oil and gas producing stocks. Those tend to follow the S&P pretty nicely. They're not following it now. Again, the oil and gas producing stocks are following more along lumber prices than they are anything in Treasury yields. But they too follow 5-year Treasury yields, which is saying that those are headed lower. So in the end of the day, when we look at the S&P 500, and now I got to get rid of it, it tells us it is in the wrong place. 5-year yields, they broke below their 50-day moving average and gapped down. 30-year yields closed or broke down, gap below their 50-day, sitting right into this channel here. Breakdown of that would have us back at our December lows on a quick revisit there. From a technical perspective, 10-year Treasury yields need to get through 2.479 before they make a move down to their December lows. And 5-year yields are technically breaking down, need to get below roughly 2.3%. So you see the Treasury market is telling us exactly what's going on in the economy, is that they do not believe at all that the stock market is right. And the bond market is always right because there's way more bonds. There's more people that own them. There's more people that trade them. It's just stocks that get all the attention. The bond market is right here. All right, let's see what else we've got going on in the charts. Take a look at gold futures. Broke beneath this support line that we looked at last week. So we have your left shoulder ahead, right shoulder pattern here. Broke down, tells us if we measure it from the top to roughly this line here, and you flip it over, it tells you it's targeting somewhere around in the 1220 range. As far as the bottom goes, there's lots of price support here, right in between here, these spots, and down here. So we would like to see prices firm up in between these two zones. So here's a zone of resistance, here's a zone of support, and right in the middle is roughly that 1220 number. So this should continue to fall. And if we look at gold mining stocks, they are continuing to fall. They had a little relief rally today, sitting right above their 200-day moving average, but that should put these stocks probably somewhere right around this $19 range. I would probably pick, if I had to pick something, right around this $19 range is where gold mining stocks ought to head. Looking at oil and gas producing stocks that have been rallying as people believe there's global growth coming, but 3 out of the last 4 weeks we've seen crude oil inventory build. This is a seasonal time for crude oil to be drawing, so that's very unusual. People keep hoping now they're banking their bets on production cuts, but nevertheless there's too much oil, and we saw the oil and gas producers get rejected at this resistance zone. And again, this should set up a move back down into support with eventual retest of their December lows. We normally don't see this one-time bottom and go. It's pretty unusual in the big picture of things. And let's take a look at 7 to 10-year Treasury bonds. Bounced off there. This is a mirror of the 10-year Treasury yields. Bounced off their 50-day. Again, setting up a big move higher here now in U.S. Treasury bond prices. Same with the long-term bond, and that is setting up a much bigger move higher here. As interest rates go down and bond prices rise, it pulls liquidity out of the market and tells us financial conditions are tight. And looking at lumber without any lines on it, that makes it a little easier to look at. You can see it's just sitting right under its, or right over its 100-day moving average. And there's not a whole lot of support there. I mean, we're looking back. Let's go. I mean, you can see there's just no support in terms of prior price action anywhere back here. So it's almost telling us that lumber prices are most likely, if it breaks out of the zone up here, they're going to retest their December lows. And if those don't hold, the next destination is going to be right around this $50 to $52 range in price. That will bring the broad stock market down with it. Let's look at the ags. Big surprise, just monster amount of selling out of nowhere. It got to this 100-day moving average, looked like it was going to hold the 50, and then boom, 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 heavy selling 3 days in a row, looking like we're back to revisit a potential double bottom. Hopefully we'll find support there and get another run. I kind of didn't like this downward sloping 50 days, so we'll see. I'm sure it'll pick up another run at it pretty quick here. So let's see if there's anything else. Oh, the dollar. So here, let's look at since we talked about it. So the dollar's getting this little blow off move here where it's shooting higher. Maybe it gets up into this $99 range. I don't know. But based on commercial industrial lending, this now should be rolling over, should start to roll over, head lower, but maybe not after one last move, which brings gold prices down. And then this starts to roll over as commercial industrial lending starts to head lower. And what's nice is we can watch the commercial industrial lending data on a weekly basis and go back and see how the dollar is doing. We know the dollar is going to lag that move in commercial industrial lending, so this is probably its final move higher. And on that note, we are hearing rumors out of China that they are short. They don't have enough dollars to pay all their dollar-denominated debt, and they do a lot of borrowing, and they do use dollars quite a bit instead of their own native currency. So that's kind of interesting as well, that we're hearing that they are short dollars, which means that's potentially there's your final thrust higher on the dollar as they look to grab some. The other factor you have is world dollar liquidity is contracting. And what have I said? We know it contracted in the third quarter. Maybe the fourth quarter day is out now. I haven't looked yet, but it's going to definitely show a contraction. And the first quarter will as well. So there's world dollar liquidity says there's less dollars, and China is now short of dollars, but everyone thinks China's flush with money. Well, they're flush with the yuan or the renminbi, and that's not something any of us really want. I'm Steve Van Metre. I'll be back with you on Friday for a more comprehensive update. Until then, bye now.